What are stocks? The easiest way to get rich, of course. But before we talk about the rich part, let's look at the definition of a stock. A stock is a piece of a company. A stock or shares of stock represents ownership. The people who own these stocks are called shareholders. Shareholders can be people, companies, or other types of institutions. The ownership of stocks has created many millionaires and billionaires who did not inherit their wealth, like Warren Buffett and Charlie Munger. So let's look at an example. If you and your family are going to eat a pie or a pizza, then everybody's going to get at least one piece or one slice. Out of the 8 slices, you get only one, but your dad gets two. You got 1/8 or 12.5% of the pizza, and your dad got 2/8 or 25%. Companies work the same way, but instead of 8 shares of stock, they could have shares of stock in the millions or even billions. McDonald's, for example, has 797 million shares outstanding. Walmart has 2.9 billion, and Facebook has 2.3 billion shares outstanding. So if you only have one or two shares, you pretty much just own like a tiny piece of the company. Now, shares outstanding is a term used to explain the total amount of a company's shares on the stock market for shareholders to buy and sell amongst themselves. Also, you are not limited by geography because you can buy stock from companies around the world. There are two types of stocks on the market: growth stocks and income stocks. Companies that see their stock price rise up really fast, like technology companies, are growth stocks. These are rapidly growing companies, and any income they make or generate is put back in the company for further growth and expansion. For example, companies like Facebook and Twitter. Income stocks, my personal favorite, are stocks that periodically pay their shareholders a dividend. This is usually quarterly, but it could also be monthly, semi-annually, or annually. The companies who can afford to pay their shareholders income are large, well-established companies. Procter & Gamble and the Pepsi Company are two companies that come to mind right now. There are benefits to owning both growth and income stocks. Growth stocks have the potential to increase in value fast, but they are also more volatile and risky. Income stocks, on the other hand, provide a consistent stream of dividend income, but the stock itself might not appreciate in value as fast as a growth stock. For these two types of stocks, there are also two different types of investors: growth investors and value investors. Growth investors love it when they see their stock price increase in value, also called a capital gain. They're also more willing to take on great risk for an even greater reward. Value investors like analyzing companies' metrics and numbers, and are willing to wait till it's the right time to buy stock in a company. Value investors are also good at discovering great companies who are consistent performers and are likely to stay consistent in the future based on the products or services they're selling in the market they're in. You might be thinking that to start buying stock, you need to have a ton of money or even be a millionaire. That's not true at all. You can start by just buying one share in a company. While I'm recording this, I just saw that the Nike stock is being sold for around $60, Coca-Cola for like $45 to $46, and Twitter for $21. Now, this is not an endorsement to buy any of these three stocks. It's just an example that you don't need to spend thousands to get going. Now, with the boring definitions complete, let's look at how people get rich with stocks. The four main ways people can get rich are the capital gains, dividends, selling short, or options trading. The last two require a bit of skill and work, and they are not as passive as the first two. So we'll discuss short selling and options trading in a future video. Capital gains are when your stock gains in value. The beauty of this is that you did not perform any physical labor. You did not do any work. It's all passive. Let's say you bought 10 shares of the $46 Coca-Cola stock on Tuesday. So your stocks are worth $460. On Friday, the stock went up to $52. Your stock, which is your capital, just increased, which is the gain, by $6. Your investment is now worth $520. So your capital increased by $60. Now, if you owned 100 or even 1,000 shares, that $6 increase would look even better. Now imagine if you owned 10,000 shares. You would have a $60,000 capital gain. With dividends, you get rich by constantly buying dividend-paying stocks, reinvesting those dividends, and you also enjoy the dividend increases from the companies themselves. Some companies even pay out special dividends every now and then. With dividends, it's more of a snowball effect. In the beginning, your income is low, but after time, it exponentially increases, allowing you to live off your dividend income without you ever having to sell your stocks. Investing to get rich and wealthy should be your long-term goal. Guys, if you enjoyed this video, that's great because I have many more coming. So hit the like button, leave a comment below, and don't forget to subscribe.